Most people have a relationship with their bank that they have never really stopped to examine. It started in a very ordinary way. Maybe a parent helped you open your first account. Maybe you got your first paycheck and needed somewhere for the money to land. Maybe someone told you that having a bank account was just part of becoming responsible. So the account opened. The debit card arrived. The app went on your phone. Life continued. And without much thought, an assumption formed. The bank is where money lives safely. The bank helps you manage your finances. The bank is on your side in some basic, functional way, a neutral place that holds your money until you need it. And to be clear, that assumption is not completely wrong. Banks do provide safety, convenience, payment access, debit cards, direct deposit, bill pay, and a financial structure most adults need to function. The bank app works. The card works. The paycheck lands. The rent gets paid. But the relationship is not as simple as most people think. Because your checking account is not just a safe container. It is a product. And once you understand that, the entire relationship starts looking different. When your paycheck lands in your checking account, you think the money has arrived at its resting place. But from the bank's perspective, that deposit is part of a much larger business model. Your money becomes part of the bank's funding base. It helps support lending, payments, liquidity, and future profit. The bank may pay you little or nothing for keeping money there, while using the overall deposit relationship to support activities that earn far more. That is not a conspiracy. That is banking. The uncomfortable part is that most people understand their bank emotionally, but the bank understands them economically. You see a checking balance. The bank sees deposits, transactions, fees, lending opportunities, credit behavior, cash flow timing, and customer lifetime value. Your checking account feels like storage. But inside the financial system, it is more like a control panel. It shows when you get paid, how fast money leaves, what bills you carry, whether you run close to zero, whether you borrow, whether you save, and when you may need the next financial product. This does not mean the bank is secretly stealing from you. It means the bank understands your money life far better than most people understand it themselves. And that is where the trap begins. Most people are taught to think of banks as neutral places. You deposit money. You withdraw money. You pay bills. Maybe you get a loan one day. The bank is just there in the background, like electricity or water. But banks are businesses. Their job is not simply to hold money. Their job is to turn financial relationships into profit. They do that through interest spreads, fees, card transactions, lending, mortgages, auto loans, credit cards, overdraft services, and cross-selling. They earn when people borrow. They earn when people swipe. They earn when money sits cheaply in low-yield accounts. And they earn most reliably when customers make mistakes, need convenience, or stay in products that no longer serve them well. The fees are the easiest part to notice. Overdraft fees. Monthly maintenance fees. Out-of-network ATM fees. Minimum balance fees. Some banks charge them. Some do not. Some can be avoided. Some are buried behind conditions that make an account sound free until the wrong thing happens at the wrong time. The overdraft fee is worth sitting with for a moment. The average overdraft fee in America has historically landed somewhere around $35. The average transaction that triggers one is often a purchase of less than $30. So the fee for the shortfall is larger than the shortfall itself. And the households most likely to trigger it are the ones already living closest to the edge of their balance, hit repeatedly by a fee that deepens the exact problem it claims to be responding to. That is not a design flaw. That is a design feature. But fees are only the visible part. The bigger cost is often the invisible one. The question most people never ask is simple. What is my money doing while it sits here? A checking account is useful for operating your life. It pays bills. It receives income. It handles transactions. But money that sits in checking too long becomes lazy money. It earns little. It blends with spending money. It feels available. And because it feels available, it slowly leaks into the month. That is where the checking account becomes dangerous. Not because checking accounts are bad, but because they can make all money feel like spendable money. Rent money, grocery money, emergency money, future money, vacation money, investment money, everything becomes one balance. And when everything is one balance, the brain treats it like one pile. that pile slowly disappears. This is how a normal month works for millions of people. The paycheck lands. For a moment, life feels lighter. Then rent leaves. The car payment leaves. Insurance leaves. Credit card payments leave. Subscriptions leave. Groceries hit the debit card. Gas hits the debit card. A few forgotten charges appear. Maybe a fee appears. Maybe an overdraft almost happens. And before the month even really starts, the paycheck has already been divided. You thought your checking account was where money lived. But for many people, it is where money passes through on its way to everyone else. This is where lifestyle inflation enters the story, and it enters in a way most people never quite name. When income rises, most people expect their bank account to finally feel different. But often, the account just becomes a larger pipe carrying more money in and more money out. The paycheck gets bigger. Then the rent gets bigger. The car gets nicer. The credit limit gets higher. The bank offers a personal loan, a premium card, an auto loan, an account upgrade. The person feels like they are moving up. But the banking relationship becomes deeper and more profitable for the bank. Lifestyle inflation does not just change what people buy. It changes what financial products they qualify for. The more you earn, the more the system can offer you. Higher credit limits. Larger loans. Better-looking monthly payments. More sophisticated ways to borrow. More ways to keep spending without feeling the full cost immediately. And because these products feel normal, people do not always see the danger. A car loan feels normal. A credit card feels normal. A checking account earning almost nothing feels normal because it is familiar. But normal is not the same as harmless. This is the trap most people miss. Banks do not only make money from people who fail. They make money from people who participate. They make money when people save passively, spend conveniently, borrow casually, miss timing, carry balances, chase rewards, and allow financial decisions to stay fragmented. And because all of it feels normal, people rarely question the structure. They question themselves instead. They wonder why the balance is always lower than expected. Why the savings account is not growing. Why the credit card rewards feel good but the balance feels heavy. Why earning more does not translate into peace. Then the failed escape attempts begin. The first failed attempt is keeping everything in checking because it feels safe. People tell themselves they are being responsible. The money is visible. It is liquid. It is easy to reach. But money that sits in checking too long often becomes spending money by accident. If every dollar is in the same place, the brain treats every dollar as available. The second failed attempt is opening more accounts without changing the position. A bills account. A spending account. A savings account. This can help behaviorally, and separation is better than chaos. But if all of those accounts sit in the same low-yield environment with no larger plan, the structure looks organized while the money still works too little. Multiple buckets of lazy money are still lazy money. The third failed attempt is chasing rewards while ignoring interest. People use credit cards for points, cashback, or status. Used carefully, rewards can be fine. But the moment someone carries a balance, the math changes. A few percent in rewards cannot beat high interest. The bank is not offering rewards because it enjoys giving money away. If the balance is not paid in full, the reward becomes decoration on an expensive product. The fourth failed attempt is treating every financial product separately. Checking is over here. Savings is over there. The car loan is just transportation. The mortgage is just housing. Subscriptions are just small charges. But the financial system does not think in fragments. Your income, payments, borrowing, saving, and habits all belong to one money life. If you do not see the full picture, you end up managing symptoms instead of the system, and the fees, the balances, and the missed growth keep quietly recurring because nothing underneath them ever changed. So what is the exact path out? The first step is understanding what your checking account really is. It is not your financial plan. It is not proof that you are safe. It is the operating account for your financial life. Its job is movement. Money comes in, gets assigned, and moves to the right place. Bills, spending, savings, investing, and emergency reserves should not all live emotionally inside one balance. The second step is separating money by purpose. Money for bills. Money for spending. Money for emergencies. Money for goals. Money for investing. The names matter because behavior follows labels. When everything sits in one account, spending becomes easier. When money has a job, it becomes harder to accidentally consume your own future. The third step is asking what each dollar is doing while it waits, and then actually moving it. Money needed for this month belongs somewhere safe and accessible. But money that does not need to be touched for months has no reason sitting in an account earning nearly nothing. High-yield savings accounts at online banks have, at various points, paid rates meaningfully higher than traditional checking or savings. Money market funds and short-term treasury bills serve the same basic purpose, holding money safely, while actually paying something for the privilege. None of these are exotic. They are simply better versions of the same job your current account is already doing badly. The fourth step is building your own system before the bank system builds one for you. Automate transfers after payday. Move savings before spending expands. Pay debt on purpose, not with whatever is left over. Review recurring payments. Cancel what no longer earns its place. Opt out of overdraft coverage if your bank allows it. Most do, they simply never advertise it, and keep a small buffer instead. The bank app should not be the brain of your financial life. It should be a tool inside a system you control. The fifth step is understanding the spread. Banks are very good at paying little on the money you keep with them and charging much more on the money they lend out. That gap is the business. Your job is to avoid being on the wrong side of it unnecessarily. Do not keep large idle cash sitting in low-yield places beyond what you need for operations and safety. Do not carry high-interest debt while chasing tiny rewards. Ask the question plainly, who is earning the spread here, me or the bank? The sixth step is becoming a less profitable customer in the right ways. Avoid unnecessary fees. Keep enough buffer to prevent overdrafts. Compare accounts. Move savings where it actually serves you. Pay credit cards in full whenever possible. Banks can still be useful. But usefulness should not require blindness. That is the emotional shift. You stop seeing your bank as the place where your financial life is safely handled, and you start seeing it as a powerful tool that must be managed deliberately. That shift changes small decisions. A paycheck no longer feels like permission to relax. It becomes a moment of assignment. A credit card offer no longer feels like opportunity. It becomes a question about cost. A fee no longer feels like bad luck. It becomes a signal that the system needs a buffer. This is not about becoming paranoid. It is about becoming awake. Because once you understand how banks make money, you can still use them. You just use them differently. You stop confusing access with wealth. You stop confusing credit limits with income. You stop confusing rewards with profit. You stop confusing a checking balance with financial security. And slowly, your money life begins to feel different. Payday becomes less emotional because the system already knows what to do. Bills become less chaotic because money was assigned before the due date arrived. Emergencies become less humiliating because there is a buffer. Savings begins to stay saved because it no longer sits beside spending money asking to be used. That is when the checking account becomes what it should have been all along. Not the center of your financial identity. Just one tool. The bank may still profit. That is what banks do. But the goal is not to make banks earn nothing. The goal is to make sure they are not earning from your confusion, your timing mistakes, your lifestyle pressure, or your future disguised as a monthly payment. Some people will keep using banks passively, paycheck in, bills out, fees when timing fails, credit when life gets tight. Others will build a system around the bank instead of letting the bank become the system. That is the difference. If this changed how you see your checking account, your credit card, or the bank app on your phone, subscribe. Because most financial traps do not look like traps. They look convenient. They look normal. They look like the tools everyone uses. And by the time people notice the pattern, years of money have already moved through them. Here, we break down the money systems shaping everyday life, in plain language, without hype, and without pretending the answer is always easy. And if someone came to mind while watching this, someone who keeps money in the bank and feels responsible for doing so, without knowing what that money is or is not doing for them, send them this. Not as a criticism. Just as a clearer picture. The accounts are not going anywhere. The banks are not going anywhere. But your understanding of the relationship between you and them can change today. See you in the next one.